If you want to retire early, one of the most important things you can do is to start broadening your sources of income, and dividend investing is a great way to do so. According to the United States Bureau of Statistics, the typical American spends around $78,813 each year, which equates to approximately $6,500 every month. Dividends may be used as a source of income, and there is a relatively quick method to accumulate enough to retire on. If you set things up properly, living off of dividends is possible. But are dividends really enough to support your early retirement lifestyle? And how is that possible today? Hello 101 community, welcome back to our YouTube channel. In this video, we'll go over how to generate enough yearly income from dividends to retire early in the shortest amount of time. Now let's start with the video. The fastest way you can live off of dividends. Let's first discuss dividends and how dividends work. To illustrate how dividends may be used as a retirement income, let's say you retire with $1 million and need an annual inflation-adjusted income of $50,000. Additionally, we can expect that long-term inflation would run at a rate of 2%. That yields on Treasury securities would be equal to the rate of inflation, and that dividends on stocks would rise at a rate of 3.5% annually. Now let's suppose that from that $1 million, you put $400,000 into Treasury bonds and $600,000 into equities with a 3% dividend yield, giving you $18,000 in annual dividend income. In this stage, in order to reach your yearly income goal of $80,000 after adjusting for inflation, you will need to sell some of your bond holdings after spending all of your dividend income. Your bond portfolio would be completely exhausted after about 21 years of holding it. On the other hand, your yearly dividend income may have increased by a third over that time period, reaching $40,000 to $80,000 per year, despite the fact that inflation was taken into consideration. Most significantly, your stock holdings would remain unchanged. After adjusting for inflation, if your dividend income increased by 33%, it is fair to assume that the value of your assets increased by a comparable amount, as their rising cash flow increased their worth over time, perhaps reaching close to $1 million. While your initial stock and bond allocation will be determined by a number of variables unique to you, it is possible to construct a portfolio of high-quality dividend companies that yield at least 3% and increase their dividends at a rate of at least 3.5% annually. But the number of dividend stocks you need to help keep your standard of living the same depends on a number of things. Investing in dividends is fundamentally a long-term strategy that calls for both patience and self-control on the investor's part. You may, however, make the process go more quickly and get closer to reaching your goal of being financially independent by using a few key tactics. Among them, the first one is: one of the quickest ways to live off of dividends is through covered call ETFs. Covered call exchange-traded funds, or ETFs, are a form of investment that provide investors with the opportunity to earn income from both the growth in stock value and dividend payments. The exchange-traded fund invests in equities, but also generates extra revenue by selling call options on the same companies. The buyer of a call option has the right, but not the responsibility, to acquire a stock at a given price within a specified amount of time. This right is granted by the call option. Therefore, when an ETF sells call options on the stocks in its portfolio, it obtains premium income, which is then distributed to shareholders in the form of dividends. And if the stock price goes up beyond the strike price of the call options, the ETF will have to sell the underlying shares, which might result in a capital gain. QYLD, XYLD, and RYLD are three of the most well-known examples of covered call exchange-traded funds. These funds provide appealing yields in the double digits, which are much greater than the yields of many conventional dividend equities. The returns on these funds are also more stable than the returns on traditional dividend stocks. These exchange-traded funds, or ETFs, are advantageous since they provide a passive income in the form of dividends and option premiums. However, investing in these ETFs does come with a degree of risk, since there is always a chance that the options could become worthless or that the stock's price would fall below its initial valuation. So how much would you need to invest in covered call ETFs in order to retire comfortably? At the current yield levels, you would need to have between $450,000 and $490,000 invested in covered call ETFs in order to generate an annual income of $80,000 from those investments. Not bad at all, right? Especially when compared to regular dividend equities, which would require nearly $2 million to generate the same amount of income as these investments. The second way to speed up your dividend-based retirement is to put your money into high-yield real estate investment trusts or REITs. Companies that engage in income-generating real estate, such as retail malls, office buildings, and apartment complexes, are known as real estate investment trusts or REITs. These businesses often distribute a sizable portion of their profits in the form of dividends to their shareholders. Blue Rock Real Estate Investment Trust, Apollo Commercial REITs, and Omega Healthcare REIT are examples of some of the top REITs for dividend income. These REITs have established track records of increasing their dividends on a regular basis, which ensures that their shareholders get a stable flow of income. CBRE Investment Management estimates that U.S. real estate investment trusts have generated an average annual return of 10.8% over the last 20 years. However, returns in these yields might fluctuate owing to a variety of reasons, such as occupancy rates and current market circumstances. When compared to conventional stock investments, REITs often provide greater dividends for their shareholders. If you wanted to retire with an income of $80,000 per year from REITs, you would need to invest around $800,000 in order to do so. This is based on the assumption that the typical yield is 10.8%. So the actual figure will differ depending on whether you diversify into multiple REITs or put all of your money in one. Realistically, you could use REITs to pay for your retirement by investing a set amount each month and reinvesting the dividends until your portfolio is big enough. If you have the right amount of self-control and patience, you can become financially independent by reinvesting in as little as 5 to 7 years. When it comes to investing for dividends, the very last thing you need to keep in mind is that you should always have a strategy. You should have a clear idea of the amount of money you need in order to accomplish your objectives. This will assist you in identifying the finest stocks for your portfolio and ensuring that you continue to adhere to your strategy over the course of time. To do this, you will first need to determine your living expenses and then check to see whether the income from your assets is sufficient to pay them. It's possible that you can get by on less than $80,000 a year, or maybe you will need much more. It is also important to note that in contrast to conventional dividend equities, covered call ETFs and real estate investment trusts often distribute profits to their owners on a monthly basis. For investors who are trying to produce a constant income from the stock market, this makes both of them an even more enticing choice to consider. Last but not the least, no matter what kind of stock, ETF, or real estate investment trust you decide to put your money into, it is essential to have an understanding of the risks that are connected to each investment and to devise a strategy that is tailored to your level of comfort with risk. Investing in dividends requires some perseverance but may get you closer to your goal of becoming financially self-sufficient than almost any other strategy. So 101 community, we hope you can use this information for your personal benefit. What do you think? Would you consider investing in covered call exchange-traded funds? Or maybe you have more interest in REITs? Share your thoughts with us in the comment section below. Stay educated. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you will be notified of every update. Also, do not forget to check out the links in the video description. Watch our video appearing on the screen. We are sure this will also provide financial training. Thanks for watching!